Welcome to BD Daily Finance News Podcast, your daily briefing on finance and investing. I'm your host. It's 2026, May 1st, and today we're talking oil shock, rate hike vibes, a suspiciously juicy dividend, and Bitcoin doing that thing where it moves but emotionally stays put.
If oil prices go up again, I'm personally switching to walking, biking, and crying, in that order. Also, if central banks hike rates again, I'm sending them my grocery bill as a formal complaint.
Story 1. Central banks are edging toward rate hikes as an energy shock revives inflation fears. The gist is, conflict-driven energy moves can push up headline inflation, and policymakers start worrying inflation expectations will reheat.
So we're back to the classic plot. Oil gets spicy, and suddenly everyone's like, we must punish the economy. Why are rates the first tool? It feels like using a sledgehammer to fix a squeaky door.
Because rates are the lever they actually control. Think of inflation like a party. Energy is the DJ suddenly blasting the volume. The central bank can't unplug the DJ, but it can make the drinks expensive, higher borrowing costs, so fewer people show up and demand cools.
That analogy is evil because it's accurate. But here's my beef. If inflation is coming from oil supply issues, raising rates doesn't make more oil. It just makes my car loan and my vibes worse.
You're right on the supply point. The reason they still consider hikes is second-order effects. Higher fuel costs can bleed into shipping, food, services, and wage demands. If people start expecting higher inflation, businesses pre-raise prices and workers ask for bigger raises. Then it becomes sticky.
So it's basically, we're not just fighting today's inflation. We're fighting tomorrow's group chat rumors about inflation.
Exactly. And for normal people, the practical impact is straightforward. If markets price in more hikes, borrowing stays expensive. Mortgages, credit cards, business loans. But the upside is savings rates can remain decent, and cash-like instruments keep paying.
Okay, but let's not oversell decent savings rates. It's like getting a slightly bigger umbrella while the storm is sideways. Helpful, yes. A vibe? No.
Fair. Action items. 1. Audit your debt. Anything variable rate is your enemy in a hike cycle. 2. Build a fuel and food buffer in your monthly budget. Energy shocks hit essentials first. 3. Don't panic trade. Energy spikes often mean volatility, not a straight line.
Story 2. I saw dividend at 11.5%, and my brain immediately went, this is either a blessing or a trap designed by a raccoon with a spreadsheet. What's going on with strategy and STRC? So yield is basically the percent off sticker at a store. Sometimes it's a real sale. Sometimes it's because the product is haunted.
Great analogy. For everyday investors, the checklist is, can the payout be covered by actual earnings or cash flow, or is it financed by issuing more shares or taking on leverage? Also, what's the risk factor driving that yield? Credit risk, business model risk, or market skepticism?
I'm going to disagree a little. People hear coverage ratio and their eyes glaze over. Can we translate? Like, if this dividend were a household, is it paying rent with salary or with a credit card?
That translation is perfect. And yes, you're right. The jargon loses people. If the dividend is funded by credit card, it can look fine until it suddenly isn't. So if you're tempted by 11.5%, position size it like a risk asset, not like a savings account substitute.
Story 3. Bitcoin ticks higher but stays range-bound, and traders keep a short bias. Translation: the price is doing a tiny victory lap while the crowd is still booing?
Pretty much. Range-bound means it's stuck between support and resistance, like pacing in a hallway. A short bias means more traders are positioned for downside or hedging. That can cap rallies, but it can also set up short squeezes if price breaks up fast.
So our theme today is energy makes inflation scary, central banks get twitchy, dividends can be haunted, and Bitcoin is emotionally unavailable. What should a normal person do without becoming a full-time macro trader?
3-step recap. 1. If energy spikes, protect cash flow, trim variable expenses, and avoid new variable rate debt. 2. If you chase yield, Demand proof it's sustainable and size it small. 3. If you touch crypto, assume volatility and use rules, limits, rebalancing, and no rent money.
And if you're about to comment, but 11.5% is free money, please also comment your email so we can send you a bridge to buy. Kidding, mostly. Subscribe and tell us, are you more worried about inflation coming back or rates breaking something?